Right. So, I had recently received a message from this guy. How do you approach the market? Yesterday you were saying you wait for the 1 hour close and hoping it will close above the level. Referring to this was a European wont trading session, October 17th. Yesterday, what I was referring to was my comprehensive analysis led me to the conclusive opinion, or anticipatory conclusion, that in order for me to get involved, it wouldn't be longs. It would be to simply wait to see if you get a nice 1 hour bar close above this in terms of shorts. So like, for example, like it trickles up and then maybe it's on the 9 a.m. 1 hour bar. It wicks above and then closes with a decent wick rejection and somewhat small body, and the top side wick must be larger than the bottom side. But I just thought that what I'm gonna do is I'm gonna go over the market outlook that I done this morning, but with my voice instead of just the video with no words and typing. I thought I'd go over it with like my actual voice. So first of all, we'll just go on to the chart. Okay, so I'm also looking at Ethereum because I'm also like I just specialize in euro dollar and pound dollar, but I'm curious on maybe it's another market, but I'm not going to ape into it. If it works really well, even I wouldn't ape into it. And then what I mean by what works well is my ability to conduct a flow approach, where you flow with how the market's set up on each given day. So I've done the outlook video on the pound this morning, and it was set up nice for longs at 7 in the morning, and but only to get involved if it retraced and provided a nice 1 hour bar close. And the reason why it needed a 1 hour bar close was because of what we'll get into. So I started on the weekly. So overall, you can see that like the overall push, where the market is situated amongst this overall push, it's situated right at the highs, but that would be relative to the monthly. Not even the monthly, maybe it's a 3 month, it would be more clearer. Yeah, so this is like the at hand push relative to the 3 month chart. And as of the most recent bar close, the info that's available, because this bar is playing out. Now, how I deal with this, the in-play bar, is subject to however the in-play at-hand push is set up now. And how I analyse the at-hand push that's in play now is simply analysing the structure, what comprises the current at-hand push's range, meaning the candle quantity within the range, because like what is a range? It's something defined by a low and a high. So you know what? And bear in mind too, if you see this, the way I conduct lifetime analysis is the same as I do in backtesting. I simply go through how the market's set up across the time frames I've got available to look at, because on FX Replay you can't have the 3-day, 2-day, and I'll see how the market's set up, for example, on the 7th of November 2019's European wont trading session, going through each of the time frames. And I know I'm digressing a bit here, but this was the 7th, I think. This was for the 7th. So like, for example, there's the subsequent day, yeah. And when considering where amongst the current in-play KI kilo range, a KI kilo range is just, for example, so you've got, so it basically, if we just start from Well, you see, I'm also a bit discretionary too. So I'll just technically the KI kilo range would be from this low that formed to the point it was broke past. Where's the highest point traded from the low that was broke past? It's here. So this would be the KI kilo range. This would be a high. This would be a low. It was broke past right here from your high to the point it was broke. Where's the lowest point traded? It's right here. So this would be technically a KI kilo range. Where's your market? Where's the at-hand push situated? Right at the high region. But then I've compared it to this low and high. The previous at-hand pushes range was closed in. Yes, the market was trading below the previous at-hand pushes key low, meaning like the overall low off the at-hand pushes range. But yes, when the market is traded below a key low, you can expect to see a reaction, but only contingent upon how the market A approaches the key low, B how the market's at-hand pushes range is structured as of the point in time that it reaches the key low, and yeah, that's it. It's simple as that. And then you can also incorporate further things, like for example, where amongst the overall push, meaning from like this low to this high. Remember, there's no systematic thing here going on. You have to realize too, I'm also operating out of my experience, and it's very important to differentiate. Okay, well, I'm not gonna say my name. If some of you probably listen, and you probably know who I am by my voice. But anyway, Mr. FF Fjellfjare is operating out of his experience, and you must be able to differentiate and discern when he is, right? So yeah, so how you can also better aid yourself in coming to the conclusion on what is most likely to unfold / unravel relative to the at-hand push that's currently in play, meaning this, because this is the at-hand push what's now in play, and how it's likely to subsequently unfold, you can better discern that by being aware of where amongst the previous at-hand pushes range the current at-hand push is unfolding at amongst, and then also where amongst the previous at-hand pushes range low and high is the market situated at. So from this point is where like the push like first started to here. Look at it's a non-sufficient candle quantity push to the downside, yet it has sufficient price coverage, thus displaying sufficient momentum to the downside. Where's it also situated amongst the overall push? Right at the highs. So number one, that adds way more weight and significance to the push, keep pushing, and on top of that, the at-hand push is not sufficiently structured compared to previous pushes, so it's likely to keep pushing on top of it already being set up to do so, based on a non-sufficient counter quantity, a sufficient price coverage, and the angle the existing structured push is pushing in, as of the most recent bar close prior to the subsequent bar that would be in play real time. Remember, I'm emulating real time. Closed in a fashion amongst that push that would suggest the push is likely to keep pushing. And yes, although it's below a key low, you would only expect / anticipate a reaction depending on whether the at-hand push was structured in a fashion for it to potentially give a reaction. Even though it might be structured to give a potential reaction, like for example, vision how the chart is set up, like from, like you can just see this bar that my cursor's over, right? Now all of this is unknown, so it's above a key high. The actual key high. The market led up to this point in a quite a sufficient structured manner. It was overextended, and then it was also overextending above a key high. And then also it's in like an area of distinct involvement where the participants at this region agreed to initially start selling from at this price region, and then the market traded into that region above this key high in a overextended fashion, and then from after this bar close, like under these circumstances, it's likely that the most probable market cycle phase to be in play is a reversal, right? But you would obviously verify that with also how next step lower time frame base time frames are set up. So below the daily, that would be a 12-hour. If you're looking at futures charts, it would be your next time frame, the 8, because that bar closes at 7. If you're looking at the CFD chart, that bar that you would need to look at would be the 9-hour, because that closes at 7. but we'll refer to the futures chart perspective, like the futures chart bar close times. And then it would be your 7, your 4, your 2, and then your 1 hour is kind of separate. Your 1 hour is the time frame that, like, all your time frames you look at paint the picture for then how you want the 1 hour to set up, based on how it's set up, like, as of 7 AM. So I'll get to this. So, but anyway, so from the point, like, where the market was sat here, yes, it was below a key low. Is it likely to give a reaction from this point? No, because of the structure of the at-hand push. So it's like, if you just read this, just pause it. So you're basically concluding the direction that the market is likely to keep pushing in as of the subsequent bar. That would be the in-play bar. And what direction is most probably likely to prevail based on the structure of that hat and push as of now. So, based on this existing structure, the existing angle, as of the most recent bar close, the subsequent bar primary direction that's likely to prevail is primarily to the downside. Now, how that bar is likely to form in terms of its anatomy, you can discern that better by looking at how next step lower base timeframes are set up. Now, oops, don't want to go on that. Now, for instance, when I see / say the daily chart is bearish, first of all, if I'm referring to it being bearish, I'm referring to the at-hand push in play, this existing structure, existing angle, and the way the most recent bar closed like amongst that existing structure and angle of that push, and how that push is overall structured setup state compares to the previous at-hand pushes range that was in play, and where it's structured amongst the previous range at-hand pushes key high, key low, is set up still of the sort where momentum is likely to keep following to the downside, and the push is not done pushing yet. Now, referring back to this, I refer to the in-play bar primarily pushing to the downside. How the bar forms exactly remains unknown. Sure, one can anticipate a bit better by utilizing how lower time frames than the daily are structured, but I foresee the move to the downside playing out over a daily time frame duration, right? So I'm saying right as in, like, okay, that's what I'm referring to. So, like, I don't mean that, oh, it's gonna go straight off the bat. Like, no, it could take some time relative to the daily chart to actually kick into play. So it could even take 6 hours into the subsequent in-play bar, right? So, yeah, and then, but primarily over that 24-hour period, or however long's left of that daily bar that's in play amongst the at-hand push that's in play, and how it's structured, how it's angled, that in-play subsequent bar is primarily likely to push to the downside. So, sure, like I said here, within that time frame, meaning the, like, however long's left of the daily bar, it can move up, forming the anatomy of the bar, meaning, for example, in a bearish case, an open high, low close, it could form the high, and you can get an idea of how that anatomy of the daily bar is likely to form as it primarily pushes to the downside. But you must keep that primary direction that's likely to play in, that's likely to play out relative to the initial time frame being analysed, being the daily. Like, that's the primary direction, right? Now, obviously, you can get peaks and troughs where, like, for example, the 4 hour might be set up to push to the upside, which then you could form the logical narrative that, okay, well, it's probably forming the anatomy of the bar, but primarily the most heavy impulsive direction that's likely to prevail is downside. So, of course, then, therefore, going against the higher time frame direction, which, bear in mind, dictates how time frames the next step lower invariably push towards, is risky. Of course, people are then saying, well, if anything's risky, yeah, of course. Because even when I've concluded what direction the market's likely to head in. For example, here, this was real time this morning. So like this was 7:50. I was based on my analysis on euro. I'm not going to go over that today. I'm going to go over pound. But based on my analysis on pound, on euro, I wanted to see the market retrace from the at-hand push that formed to the upside as of the lead up to European morning trading session. I wanted to see it retrace to better prices, aka the optimal trading range. I don't like calling it shit like this, but it's just better to like differentiate in your mind. Okay, yeah, I know. Like when you say optimal trading range, you know what you're referring to. It's just the 60 to 70% region of the off an at-hand push, right? So anyway, yeah, I wanted to see it retrace to the 1 hour optimal trading range. I'm aware of all the ICT stuff off our optimal trading range, the silver quack bullet, or you know, all that crap. Well, whatever. Let's not get into this controversial topic. And then anyway, I wanted to see some signs that momentum to the downside was gonna I wanted to see some signs that participants were willing to agree upon trading with the prices that the euro dollars were trading at in this region, in a way that showed that, yeah, okay, momentum relative to the 4 hour, 7 hour, 8 hour and 12 hour was likely to indeed then take hold, right? And then basically after that 1 hour first initial intent exhibit of the bar close, I would have then looked for an intra-session liquidity sweep. I hate those terms, but that's just what I call it. Specifically, I call it ISLQS, intra-session liquidity sweep, which can just, and then basically in short, a 15 nice bar close, which is just basically this, a nice bar close. Where the anatomy of the bar closes on side to a particular direction. So I haven't actually done the outlook for pound in Discord, but what I have done is I've done it on the the chart itself. So like, yeah, so it's like the upper and lower limits of a particular like thing. So like the computer that you're looking at, you've got the low and high. That's the range. Inside of that, you've got the sectors within the range. You know, so you've got the upper half, you've got the lower half, and then you've got different regions within that, right? So yeah. Anyway, if we just get straight into it, otherwise this video is going to be ages. If we just start on the 3-day. Oh my god! So this is from yesterday, so ignore that. Now, if you just ignore all the text, remember we go based off the most recent off the data available as of the most recent bar close, because this bar still has 2 days, 12 hours left relative to the 3-day chart perspective. That's a lot left of this bar. This is just in play. This could easily have formed the anatomy of this bar and then continue pushing lower. Now, that is probably the likelihood case. It's a bit iffy relative to this, because this bar is closer to being done than not, right? It really depends on how the next 3-day bar closes. But yeah, anyway. So as of the data available as of the most recent bar close, we see the previous range's at-hand push was closed in, meaning all of this range, the prices participants traded the underlying product at and resulted in the market facilitating a push closing in the whole region of this range and below the previous at-hand pushers range's low, which was also the key high low range pivot low. So you have this range from this high to this low. You've got 2 candles that form from this high. One of them is opposing to the trend the push pushed in primarily, thus bearish, which can also be the first bar. So you got like your bearish bar, you got this, they got your initial high, and then you got 1, 2, and then this is a formed high kilo range pivot. And then from this high kilo range pivot, it was traded past here. the low that formed from the key high that was broke past is now key low. It was traded past. Now, yes, a reaction is likely to unfold, but we only decipher whether that reaction is indeed likely to unfold or not based on... Oh, that's a new addition. There used to only be 10. Bit small though. But you would only be anticipating a reaction, like, properly contingent upon how, number one, remember how the atom pushes to the POI. The POI can be anything. It can be a key high, key low range pivot. It's just a key low, key high. It can be an imbalance. It can be a silver quack bullet, fished scope. It can be a supply demand zone, whatever. And I don't even call them supply demand zones. I just call them zones of distinct involvement, basically. Like where it's just where on the chart it's just clear. Anyway, so how the market approached this kilo, it is sufficiently structured. It's sufficiently price coveraged, meaning like the price coverage per each bar comprised within the overall structure range of this at-hand push is sufficient. How the previous, but then based on the most recent bar close as of the breach of the key low, how is the at-hand push structured? Is it structured in a fashion that's likely to result in a reaction? No. Where is it situated amongst the low and high of this overall pushes range? It's situated at kind of the high region, and it's also still structured in a fashion for momentum to keep pushing lower. Based on how it also approached this zone, you would kind of want to see like maybe something like this, basically. You want to see like this, and then maybe it's like a small body close, and then like a wick. And then, yeah, the push could then possibly push to the upside. But, like, as of now, it looks like it's still going to continue lower relative to the 3-day. So you basically see how the push is structured when it trades below the hand push, and whether it's likely to keep expanding lower or whether reaction could unfold. And the reaction isn't poised to unfold. Same drop to the 2-day. So, based on the 2-day bar, you see the previous bar close to the bar that's in play had a slight wick rejection below this key low, which is also the key low relative to the 3-day. But you would confirm whether this liquidity wick reject cardinal close, as I call it, aka LQWRCC, is likely to prevail in a reaction based on whether time frames the next step lower are set up for that push to do so. So anyway, because this is quite a nice structured push up to here, and then how the market's trading as of when trading past this key low, it is somewhat set up nice if base time frames the next step lower, or set up to prevail to the upside too, or set up for structural wise to push to the upside. Now, daily looks good to push higher if you also look at the short term range, because obviously, like, you've got, like, for example, you've got the overall, like, this is like the overall structure, and then you've got, like, for example, like here you've got this. So, oops. You've got this too. So you've got the short-term structure and stuff, and then I also do incorporate media. It's all relative to the situation at hand on today, in terms of now. It's got nothing to do with the past. It's just how it's set up now. And anyway, amongst this structure, amongst the range of the short term relative to daily hand push, which would be more clear on lower time frames, this is set up nice amongst the previous hand pushes range to the downside pushed up to the upside within the subsequent daily bar. Now, as we see, that did unfold, and it has played out quite a decent amount of this range, and it's also like this. But remember, I'll just focus on how the market's set up as a key time periods, right? So 3 p.m. UK time and 7 a.m. UK time, based on, I've structured that around where bar closes close. Anyway, so you see this push is nicely structured. You're below a key low relative to the daily chart perspective, and in short-term structured slightly for short-term relative to daily push to the upside to prevail. So short-term relative to daily would be relative or in sync with this like structure. So it's not going to be like all the way up here. It's going to be relative to this. You know, it's going to be respective to this. So like this is like, I don't know. For example, this is about 1,300 pips. By the way, if I'm saying that wrong, the pips or whatever, I might be. I'm not sure. I'm pretty sure that's 1,300 pips, because the 94, that would be, that would be, fucking hell, 10 pips, that would be 94 pips. Yeah. Bloody hell. Okay. So, yeah, the move is going to, like, when I say short term relative to the daily, that is short term relative to the daily. So maybe it's like a push up to here. Now, on lower time frames, of course, that's going to be a hefty move-ish. But then anyway, as we drop down, we see the most recent bar close prior to European morning trading session. It closed really nice amongst the structure of the previous at-hand push to the downside 12-hour impulse move. And it did look kind of done based on the structure of how the structure then formed. Now, we're also below a 12-hour key low. The market's nicely structured relative to previous pushes, nearby to the relative 12-hour market auction, or nearby relative to how the market had auctioned relative to 12-hour time periods. And then the way bars closed at below the key low amongst the structure of this push suggested the push could easily like push to the upside, and that is also synced with a daily. It's pointing to the 2-day time frame prior bar close actually prevailing in some sort of a liquidity rejection, and then follow through with a reversal. So then you go down. Once again, beautiful for upside. This would have been a really nice day if the setup actually formed, but it just blasted up. Same thing with the 7-hour. And then 4-hour time frame, it's getting a bit iffy, because you see an at-hand push has already prevailed as of like 7 a.m. open. It's already kind of pushed to the upside relative to 4, right? So this is why I wanted to see a 1-hour bar nice close at the optimal trading range. It come down from the prices it had been traded to at those relatively high prices relative to 4 1-hour time periods, and then see participants show me, collectively participants I'm referring to, trade with, like, show that there's willingness to buy the underlying product, right? At that region, reflected within the way the 1-hour bar closes at a retraced region. But then also you have to keep in mind how the chart perspectives relative to the 8 and 12 hour are set up for momentum to take hold from that relative time frame bar, like in next subsequent bar in play. Now, relative to 8 and 12 hours, it was set up for the market to primarily push to the upside over that subsequent in play bar, which is unraveling. Anyway, the next time frame is 2 hour. So here is when I was like, yeah, for sure we're going to need to see a nice 1-hour bar close, and it was structured nice for that 1 hour to retrace. If you look at how it's compared to the previous 2 hour range, it's kind of closed it all in. and it traded to the upper extreme region of this 2 hour. Now, I still expected this to be broke past based on how next step higher time frames are set up for momentum to take hold over that subsequent bar in play relative to the 8 and 12 hour time periods, and how those relative time periods were set up for momentum to take hold over. So I didn't hold much significance of this. Like, I wouldn't have looked for shorts because I could have easily got steamrolled. I wanted to look for longs. Anyway, this just basically added to further conviction for the market potentially retracing to this region. Based on the structure of the at-hand pushing up to this extreme region, the angle started to fade compared to the initial push, you know, and it was like not so sufficient price coverage per bar, but many bars. So it's just like a slow grind to the upside, and it's sat right at the very highs of the at-hand push to the upside. You don't want to be buying up here, even though momentum from that next bar relative to 8 and 12 hour time period is primarily likely to keep pushing upside. You still don't want to get involved at the highs of an at-hand push, because you can easily get caught on the wrong side, especially if you're trading relative to the 15M time frame. If your stop's like here, well, your market can easily push lower, you know. So it's best to just wait for it to push lower, get confirmation from the 1 hour nice bar close, and then and then if momentum's gonna keep pushing lower, then you're not gonna get a nice 1 hour bar close, and you're invariably gonna get kept out of a losing trade. So yeah, and then well, the 1 hour even just added even more of a perspective of what was likely to unfold. I mean, this push was sufficiently structured to the upside. You don't want to buy up here. It's very likely it's going to retrace, but it didn't. So that's how I do it every single day. It's always based on how the market's set up today, and nothing else. Doesn't matter how it was set up the prior day. Doesn't matter how it's set up any past day. What matters is your ability to deal with how the market is set up today. Deal with the information that is available today. Flow with the data that's available today. That influences what decision you make today. It's all about now. But you can also aid the procedure in determining what is likely to unveil with regard to the at-hand push that's in play now, in terms of its structure, its angle, and where amongst the existing structure and angle of that at-hand push in play the previous bar closed amongst that structure and angle of that push, by using how that compares to the previous at-hand pushes range, the previous at-hand pushes range high and low, and then the overall key high and key low, and then also where it's situated within, for example, the overall push, right? That can also aid your how can you say it? Aid your process in establishing what the market is likely to do relative to a certain time frame, relative to the at-hand push that's in play. So yeah, that's how I do it.